2016 has been a standout year for the wrong reasons. The ongoing war in Syria intensified. The immigration crisis grew ever more urgent. The long list of celebrity deaths reminded us of our mortality. To trump it all, American politics lit up the end of the year with a spectacular shock that left pundits scratching their heads. But where was the world of business in all this? How did it fare in such a turbulent year? "2016 started precariously. No sooner had the winter festivities come to an end, Indian steel giant Tata Steel said it was cutting 1,050 more jobs in Britain, following thousands of cuts in the industry announced in 2015, blaming China for plunging steel prices. In October 2015, Tata Steel had said originally it would cut 1,200 jobs in Britain. It also stated in December of that year that it was in talks with investment fund Grable Capital to sell some of its European assets, employing a total of 4,700 people. At the time, Tata said, "The proposed changes follow continued falls in the European steel price caused by a flood of cheap imports, particularly from China." The additional 1,050 steelworkers threatened with redundancy was another blow to an industry on the verge of a prolonged countrywide crisis.
It'll just disappear, it'll disintegrate. There'll be nothing here for anybody. All the Tesco's will shut, all the houses will go. So there'll be nothing here for anyone. We'll all have to move away.
Fast forwards towards the end of 2016, and Britain's steel industry now appears to be in recovery mode. The Scunthorpe complex is perhaps the best example of this. The group, sold by Tata Steel to Grable Capital in May of this year, announced it had turned from significant losses over the last few years to a stage where it was now back in profit. One of Tata Steel's biggest operations is at the Port Talbot plant in Wales, where it employs 4,000 people, many whose jobs were also under threat. However, after almost an entire year of uncertainty, its thousands of employees were finally told by Tata Steel in the last month of 2016 that their jobs would be secure for at least 5 more years via a 10-year, £1 billion investment deal. But workers still have to agree to pension changes and will be balloted. The next big business story of 2016 arrived in April, when British retailer and institution BHS announced it was going into administration after a botched business deal by its then owner, Philip Green. Shortly afterwards, British MPs branded Green, a billionaire tycoon, the unacceptable face of capitalism in a report about the collapse of the department store chain, which caused the loss of 11,000 jobs. The lawmakers also called on Philip Green to address urgently the shortfalls in a pension fund of 20,000 former employees. BHS, which sold clothing and homeware, failed to keep pace with traditional rivals such as Marks & Spencer and online giants like Amazon, resulting in a major loss of market share. The 88-year-old company had 163 stores and 74 franchise operations across 18 countries. When it collapsed, BHS had debts totalling more than £1.3 billion, including a £571 million deficit to its pension fund. Green bought BHS in 2000 for £200 million and sold it in 2015 for just £1 to Dominic Chappell, a former bankrupt businessman with no retail experience. The government is currently reviewing Green's knighthood, with MPs already backing a motion to remove it. Meanwhile, Green himself has reportedly said he will pay a lump sum back into the pension fund. In slightly more cheery news, 2016 was also the year that the self-driving car started to look less like science fiction and more like reality, as a whole host of established businesses jumped on board the bandwagon in an attempt to kickstart a concept with roots that can be traced back to the 1920s.
We believe at Google that we must focus on nothing short of full autonomy.
Google was the first to boast about its fully automated car, after announcing in 2012 it had completed 300,000 autonomous driving miles without an accident. Fast forward to 2016, and the development of self-driving vehicles hasn't come without its problems. First came Tesla's rival autopilot system that muddied the waters over what direction self-driving vehicles might take. Then a series of accidents resulting in one death darkened the mood. However, fully autonomous vehicles have made giant leaps of late, especially after the UK trialled its first ever self-driving test in a public space using a series of cameras and lasers to navigate the car's route, rather than the more traditional GPS system. Although the system is currently only being trialled on pedestrianised streets at speeds of around 5 miles an hour, self-driving cars on British roads are essential for British-led innovation, according to Programme Director Neil Fulton.
If the UK doesn't get involved in this space, we will definitely be left behind. And this is a great example of fantastic UK technology staying ahead of the field.
The technology will also be piloted in London's Greenwich Borough to run 8 vehicles around pedestrianised areas in 2017. Next up is a big British buyout. After Japanese mobile giant Softbank announced over the summer it had agreed a takeover of British chip designer ARM Holdings worth around £24.3 billion. The company said at the time it would offer £17 for each ARM share, a premium of around 43% compared with the previous price, sending ARM rocketing more than 40% at one point in London. The all-cash offer was of course unanimously backed by ARM management, and British Prime Minister Theresa May declared that the record Asian investment proved Britain is open for business, just weeks after the country voted to leave the European Union. For Softbank, however, things didn't go as smoothly, as the company plunged more than 10% shortly after the purchase as investors gave the thumbs down. Softbank, led by founder and big risk-taker Masayoshi Son, had effectively just lost around £5.5 billion in market value. Softbank has been selling off some assets, including game maker Supercell, and trimming its investment in China e-commerce company Alibaba to raise cash. But it had more than £78 billion in debt at the end of March this year. Cambridge-based ARM was Britain's biggest technology company, and there were concerns once again that the country was selling off its crown jewels for a quick buck. However, the reality was that more than 95% of the company's investors voted in favour of the deal, which isn't particularly surprising when you consider the asking price. "2016 had started downbeat, as many smaller businesses continued to worry about their future in an increasingly more cash-strapped world economy. Then, in Britain, the 5th largest economy on the planet, this happened.
The UK has voted to leave the European Union.
This unprecedented result on the 23rd of June 2016 to decide whether or not Britain would leave the EU sent out a shockwave that will last for years to come. Shortly after the vote was declared in favour of so-called Brexit, and having called for the referendum in the first place and campaigned to remain in the EU, former British Prime Minister David Cameron announced he would resign.
"I will do everything I can as Prime Minister to steady the ship over the coming weeks and months. But I do not think it would be right for me to try to be the captain that steers our country to its next destination."
The final margin was more than 1 million votes, swayed by promises of independence from the bureaucracy of Brussels and stricter control over borders. 52% opted in favour of Brexit. Delight and disbelief in almost equal measure. The shockwave saw the value of the pound and global stock prices plummet. The Bank of England then stepped in to secure market stability. Britain is gearing up to become the first country to leave the EU in its history. A lengthy and possible painful divorce from Brussels is looking likely, although some European officials want the whole process done and dusted by October 2018. At stake is also the unity of the United Kingdom, with a second independence referendum for pro-European Scotland a looming possibility.
I am determined that Scotland will have the ability to reconsider the question of independence and to do so before the UK leaves the EU if that is necessary to protect our country's interests.
The British people have made a very clear decision to take a different path.
For Cameron, his gamble on a referendum failed spectacularly. Now, at the end of 2016, and looking ahead, the sheer scale of detangling Britain's many laws, agreements and endorsements forged over the years with the EU will be a monumental task for Theresa May's new Brexit team. Britain's surprise vote to leave the European Union sent shockwaves across global markets too, as it ushered in a new element of uncertainty in a world already plagued by weak growth. Sterling crashed 10% to a 31-year low at one point, and the euro also plummeted against the dollar as traders had banked in the run-up to the vote on Britain opting to remain in the EU, based on polls and bookmakers' predictions. But in the Eurozone, the losses were of a magnitude unseen since the dark days of the global economic crisis. The Frankfurt Stock Exchange suffered a 6.2% blow shortly after the news was announced, whilst Paris slumped 8%. US stocks also fell 3% in late morning trading following the news. The dollar slumped briefly to 99.02 yen, the first time it's gone below 100 yen since November 2013. The Japanese unit is considered a safe bet in times of uncertainty and turmoil. But it left analysts, journalists, policymakers and bookmakers staring themselves in the mirror asking, how did I get it so wrong? Highlighting the uncertainty, US investment bank JP Morgan warned that it could relocate UK jobs abroad. Banks took some of the biggest hits. In Britain, Lloyds tumbled 21%, RBS 18.8% and Barclays 17.7%. Investors also sought the relative safety of government bonds. The price on the German benchmark 10-year sovereign bond rose sharply, pushing its yield into negative territory for only the second time in its history. UK government bonds also rose, taking their 10-year yield to a historic low. Gold, a traditional refuge asset, struck a 2-year high. But elsewhere, billions of dollars were wiped off investment portfolios in a matter of hours. Certainly a period in 2016 many will want to forget. Shortly after initial reactions to Brexit and the real possibility of an impending recession, the Bank of England's Governor Mark Carney was already appearing on TV screens around the world, trying to reassure the markets and businesses that everything was under control. He did this by offering new stimulus measures, and in the process announced another unprecedented decision to cut the interest rate to a mere 0.25%, down from an already historical low of 0.50%.
The MPC is today implementing a timely, coherent and comprehensive package of measures.
Great for borrowers, punishing for savers. So if you're on a tracker mortgage for your newly purchased home, you'll definitely see savings, as it's now cheaper for mortgage lenders to loan to you. So what were these stimulus measures? Well, the Bank of England backed a £170 billion stimulus package shortly after Britain's exit from Europe became a reality, which perked up the markets. The bank's 9-member Monetary Policy Committee, or MPC, also agreed to reactivate its quantitative easing bond buying scheme, lifting it by £60 billion to a total of £435 billion in the first QE increase since 2012. Although the BOE maintained its 2% economic growth forecast for 2016, it slashed the growth outlook to 0.8% in 2017 and 1.8% in 2018. That compared with prior predictions of 2.3% for both 2017 and 2018. The BOE had already hinted previously that it might deliver an interest rate cut in August in response to the Brexit referendum. British borrowing costs now stand at their lowest level in the central bank's 322-year history. Just as 2016 was winding down, the tech industry's biggest player, Apple, announced it was planning on using the iconic but now defunct Battersea Power Station as its new London HQ. In a move seen as a direct challenge to Google's presence in the tech capital of Europe, the Grade 2 listed building is now undergoing a multi-billion-pound restoration programme and will see many existing London Apple employees move into the building by 2021. The tech giant will become the largest company to occupy the former electricity generator and is expected to take up roughly 40% of the total space. The Battersea Power Station has been sitting on the banks of the Thames for decades, and a number of Sukuk-funded residential and commercial properties have already been erected near the site. Meanwhile, Google confirmed it will expand its vast campus in central London, a move that is expected to bring 3,000 jobs to the capital. Google announced it would add a new office building to a complex currently under development behind London's King's Cross station, which the tech firm said would be its first wholly owned and designed building outside the US. The 10-storey building adds to Google's previously announced plans in London, with 2,500 Google employees already working in one office and more due to move into a building set to open in 2018. In total, 7,000 Google staff will eventually be working at the King's Cross hub, with no date given for the opening of the newly announced third office. The deepening commitment to London by Google and Apple comes as the government tries to reassure the business world in the wake of Britain's decision to leave the European Union. A study released from the Centre of Business and Economics Research said British businesses have cancelled or postponed investments worth more than £65 billion. And finally, some of you might remember 2016 for reasons relating to public transport. No, I'm not talking about the state of Britain's railways. I'm talking about the unstoppable rise of taxi startup Uber. Well, I say unstoppable, but that's exactly what many conventional taxi drivers tried to do throughout 2016, blocking traffic in cities across Britain and Europe. Cab drivers, particularly those of London black cabs, were protesting that they simply couldn't compete with Uber's very competitive prices and that job losses were on the cards. Thousands of drivers brought their vehicles to a standstill around Parliament Square, Whitehall and Trafalgar Square, tooting their horns at regular intervals to make their discontent clear. They said that while they have to comply with a string of regulations, including passing the Knowledge, a famously tough test in which they have to memorise tens of thousands of destinations, drivers for the ride-calling app do not.
We are not standing for this Uber business anymore. We've worked 4 years on our Knowledge to pass and to get this badge that we've worked so hard for. Why should they come in and just be able to just free rein? No rules, regulations for them, yet there is for us.
Taxi drivers across Europe also joined in, causing huge tailbacks. Brussels airport was blocked off as they descended on the EU capital. The international convoy of around 300 taxis crawled into the city's busy European quarter in hopes of meeting Belgian and EU officials, bringing traffic on main roads to a standstill. Their anger has often boiled over, notably in Paris, where rioting by taxi drivers and the arrest of 2 Uber executives in June led the company to suspend its lower-cost Uber Pop service. Meanwhile, a Spanish court has asked the EU's top court to decide whether Uber is a technology application or an old-fashioned transport company that would require far stricter regulation. Anticipating these court decisions, Uber has launched an upmarket alternative service called UberX in several European markets, which requires professionally licensed drivers. Valued at an astonishing £55 billion, Uber has expanded rapidly in cities around the world, but has yet to turn a profit, having reportedly lost around £3 billion over 2 years. So that's it then. It's been a tough year for all. We leave 2016 with bated breath and wonder if 2017 will be any better. Well, Forbes does. It says 2017 will see crowdfunding overtake venture capital and is currently one of the most exciting ways to raise cash, as investors can use it to test whether a product will take off or not before they invest. So it's not all bad, right? Enjoy your new year. Goodbye.